the Sure Investing Podcast, investments and strategies to help you safely compound your wealth over the long run. Hey everyone, in this episode I'm excited to be interviewing Andrew Sather, the founding publisher of einvestingforbeginners.com and the Sather Research e-letter. Andrew is passionate about helping educate individual investors and helping them to avoid common mistakes in the stock market. He's also a gifted analyst of financial statements, which is a major focus of this episode. Stay tuned for more. So I thought we could just start by talking a little bit about, who you are and what's your place in the world of investing.
Yep, my name's Andrew. I've been investing since 2012. Basically, I started out and I was just brand new to the whole world of investing. I didn't really see any step-by-step guide, so I kind of shot from the hip for a while and just try to kind of glean different lessons as I could from different, blogs and websites. The whole thing of it didn't really catch on until I started to really dig into some of the best books that are out there. There's books that Warren Buffett has recommended. There's other books that a lot of other investors, you can get their track records and look at as hedge fund managers or general fund managers. Guys like Buffett who invests as part of his company and he owns that company, like Berkshire Hathaway. A lot of these books, and so I just happened to stumble into those and I was able to take those lessons I was learning, and since I didn't see any sort of step-by-step guide to investing, I ended up starting a blog myself and kind of just tracking my progress and trying to teach as I went. And so as I was teaching, it really helped solidify the things I was learning, and that's where I'm kind of at today. So it started out as a blog, it progressed into a podcast, and now I'm flown into trying to help people understand the most basic parts of the stock market. Basically understanding that when we look at something like the stock market, it's not a bunch of numbers on the screen. It's not brokers yelling at each other and big heads on TV making these clips of audio that are just so catchy and sound so dramatic. Really what's behind the stock market is it's a collection of businesses. And when you look at a stock as not buying a stock, but I'm actually buying into ownership of a business, then you can really start to understand how to move and how to make the sorts of decisions that an owner would make. And you can take that and really apply it to your portfolio. And so I really believe that's the best way to grow your money through something like investing. I look at a lot of different, you look at the investing world, there's so many options. You can do real estate, you can do, crypto is a huge thing nowadays. You have like insurance products and all these different types of assets that you can really purchase. I've found for my own, what I prefer and how I like to really stay passive. I don't want to have to deal with contractors and real estate repairs, even though it might be very lucrative. And at the same time, I also try to structure my portfolio so that I'm always getting an income. That's huge to me when we talk about investing, is a steady stream of income. Once you get income, that creates compound interest, and that really grows your money in a really big way, in ways that's a lot more reliable than being able, we have a crystal ball and we're able to predict exactly which stock, which company, or which asset's really going to grow. So I really try to take these big picture concepts and a lot of the things that are, you kind of have to dig into the books a little bit, and it can kind of make the average person maybe gloss over it. So I try to really keep things as simple as possible and explain it so that whenever somebody's listening to what I am talking about, that they can really understand it conceptually. And I think making that first step of how am I going to understand the stock market, once you get that momentum going, then you can really start the great results in the market. You're not going to jump into the market and expect to be somebody who's going to make fantastic returns overnight. It's a process, it's an education, and it's really investing in yourself, and it's an investment that's going to last for the rest of your life. In order to get there, you really need some quick wins. You need quick concepts, and you need to let those skills grow. And so really that's everything I've tried to do online. It's everything I do with my own personal investments. And it's something that I hope anybody who's listening, that I can help them with that too.
So you mentioned that you started investing back in 2012. What made you start being interested in the stock market and investing in general? And how would you say that your philosophy has evolved over time?
So I was fortunate in the sense that I really stumbled into it. I started out of college, got a great internship, started my first job, and I happened to have one of my coworkers there, and he started really introducing me to this world. He told me about things like dollar cost averaging and diversification and long-term investing. So that's really what kind of piqued my interest. I know you might hear a lot of people who say they wish they could have started early. Obviously, I wish I started when I was in my teens, but it is what it is. And so the big moment for me was seeing him pull into the parking lot at our work and pulled up in a brand new Corvette. I knew he had several other cars as well. I was like, wow, that's really cool. And he's like, yeah, I sold some stock and I was able to get to have this Corvette. So that really fired me up, and I was like, oh, wow, you can actually make serious money from the stock market, and you don't have to be this guy who's living on Wall Street, on the trading floor. These are everyday people who are making money in the stock market. So that really kind of kicked me off and got me going. And my type of personality is once I get into something, I kind of go 110%. So I have an engineering brain. I come from an engineering background. Numbers just speak volume, and I'm able to look at them and understand what kind of a picture numbers are telling me. So I got into that whole numbers side of investing really early, and I found a approach that really reflects looking at a business as a set of numbers and understanding that when the business posts their numbers, they are telling you how well the business is doing. So it's a very objective way of looking and really getting very good evidence on how a business is doing. So that's basically, I got into Benjamin Graham and value investing, and it's basically finding great businesses and finding them when they're cheaper than normal. And that's the approach I've taken. I have a lot of various differences, so it's I'll learn these concepts and really master them and then take my own unique approach to it. I think everybody has their own unique investing approach. I tend to be very heavily focused on dividends. I only buy a stock that's paying a dividend, and I also always want to buy a stock that is trading at a discount to its intrinsic value. And the way I evaluate intrinsic value is not something I've ever heard anybody else say. So that's the kind of stuff where I also not only learned from books and other great resources, but I also did some research on my own and tried to analyze a bunch of companies like that as I went along. And I looked at what are some things and what are some numbers that companies show when they're about to do very well. What do they show when they're about to do poorly or go bankrupt? And from there, kind of crafted an approach to where I'm buying. Dave and I talk about this on the podcast all the time. I'm buying with a margin of safety with an emphasis on the safety. Warren Buffett talks about his 2 rules to investing, right? Rule number 1 is don't lose money. Rule number 2 is don't forget rule number 1. So I take a very similar approach in a different way, and it's just basically looking at the numbers, looking at what a business is telling me about how healthy they are, and then moving forward and building a portfolio of as many of these great businesses as I can and just trying to hang on for the long term.
Now, you mentioned that when you started your website and started investing in general, you read all sorts of investing books and then compiled the knowledge from these books into your website. With that said, what are your favorite investing books, and which ones would you say have had the most outsized impact on you?
I think the obvious one's The Intelligent Investor. That was the one Benjamin Graham, written by Benjamin Graham. He was Warren Buffett's mentor, and he had a ton of students that ended up becoming, they even dubbed them the super investors of Graham and Doddsville, because these guys all were able to outperform the market, do fantastically well. And it's really, when you talk about somebody who says they're a value investor, likely they have read that book and consider it one of the greats. I also liked A Random Walk Down Wall Street. That book's more geared towards index investors and talking about why indexing is a good solution for a lot of investors. I loved it because it really laid out a lot of different approaches that you could take to the stock market. So while it obviously had its favorite and it had a bit of a bias, it still told a good story about what the different options are. So you could look, if like charts and technical analysis tends to be something that kind of jumps out to you as something that speaks to you and you understand the logic behind it, a random walk down Wall Street presented that as one of your options and presented a lot of the different strategies. So I really like that just from a general investing standpoint. And I like from a personal finance standpoint, The Richest Man in Babylon. It's like $6 or $5 book, and you could literally knock it out in like an hour. And I think it's so critical that in order to start running, you got to learn how to walk. And in order to become good at investing, you got to make sure you have your finances in order. And so that was a really great book for me that put everything into perspective. Obviously, there's a ton, and it's hard to narrow it down, but I would say that those would be probably my big three that I really enjoyed.
One of the key principles of the intelligent investor, and it's something that you touched on earlier in your discussion as well, is to buy stocks when they're trading at a discount to their intrinsic value, or in other words, to buy them with a margin of safety. Now, the trouble there is that sometimes stocks are trading at a discount to their intrinsic value, and they go lower and lower, and it turns out you may have been wrong about their intrinsic value. So how do you determine whether a stock is a value trap or whether it's an actual bargain stock that should generate solid returns going forward?
Yeah, I love that question. The whole idea of don't try to catch a falling knife, right? So what I did, because I understood intuitively, I'm going to be trying to buy stocks that are, if they're at a discount to intrinsic value, that means that the stock market doesn't view them as favorably as maybe as usual or as favorably as the other stocks and the other options that are out there. So if you want to be a true value investor, you're going to have to be a contrarian. That's first and foremost. Understanding that, and then you have to understand there could be several reasons why a stock's undervalued. Either a stock is undervalued because, yes, actually the business is failing, or a stock could be undervalued just because maybe it had a short-term hiccup, or maybe it had something that negatively looks bad in the near future, but in the long term, it might still have a very great business model. I did some research, and I went back because I wanted to see, everybody talks about how much money can I make. Everybody talks about the big stocks and the big gainers, the Amazons and the Netflixes and all these stocks, the Googles, the ones that have just created crazy amounts of money, right? But nobody talks about the losers. And so I kind of flipped it, took a backwards approach. I went back, and since I'm really big with numbers and I loved plugging things into a spreadsheet, I went back and I took the 30 biggest bankruptcies of the 21st century, and I literally just plugged all of those numbers manually into my spreadsheet, and I looked at every major metric on their financial statements. What I found was that when a company that is likely to fail probably has negative earnings, that was actually my biggest finding, was that the vast majority of these stocks looked at had negative earnings either the year before they went bankrupt or several years before they went bankrupt. So when I started to look at stocks trading at a discount to my intrinsic value, I understood that I want to stay away from them, because if this is a common characteristic, why do I need to put that into my approach? Why do I need to buy stocks that have negative earnings? It just kind of makes sense. The other thing I really saw was there seemed to be a correlation. A lot of the stocks that ended up going bankrupt had really high debt levels. And what I kind of saw was that the higher the debt level, the more likely a company was to go bankrupt. And sometimes you'd see this over a several year period. You would see the debt maybe look okay. And I use a debt to equity ratio. That's how I evaluate this. But maybe one year it's okay, and then it starts to rise, and then it really gets high, and that's where things can be very troublesome. And it's a company that's showing you symptoms of a failing business model, and so it's really just understanding what those failings are, and then simply avoiding them. And so those are the big ones that I've seen. A company can have declining earnings, and it can have maybe lower cash flows, things like that. But to really have like a year of negative earnings or a really high debt increase, or both combined, I see those as serious issues, And so by avoiding those, I really avoid a lot of the downsides to picking at these bargain stocks.
And to get that information, do you go directly to the source, like the company's financial statements, or do you use a separate data provider?
Yeah. So nowadays I use, and it's funny because, in this day and age, I hardly ever memorize anything. So I have it saved as a bookmark on my computer, right? So it's either ADVFN or ADFVN. I can't remember which one it is. That one pulls the information from the financial documents on SEC.gov. I tend to use that when I'm sifting through a lot of different companies, when I'm picking stocks today. When I went back and did this research on the history of these different stocks, that's when I went straight to the source because I didn't want any sort of dilution of or potential mistakes on the data. Plus, a lot of these companies that are bankrupt now, they don't show up on a lot of these information providers. So if you're trying to do like research, kind of like a back test almost, but in my case it's more manual. I was kind of having to Google and pull up the financial statements in that way and not able to use like a data provider. But I do like ADVFN. I like to use like stock screeners like FinViz, but obviously going straight from the source is ideal if you can spare the time.
You mentioned a lot of the key metrics that you look at when doing financial statement analysis. Now, obviously, those come from not just the income statement, but the balance sheet and the statement of cash flows as well. Would you say that there's a particular financial statement that you tend to emphasize more when doing your due diligence?
I definitely emphasize the balance sheet and the income statement, not such the cash flow statement. A lot of investors will look at the cash flow statement. I see nothing wrong with that, but I prefer to really keep things as simple as I can. When I look at something like the balance sheet, what the balance sheet is telling me is how the long-term health of a business is really performing. So if you think about business in the most simplest sense, you have a business and it has assets. What you want those assets to do is to create cash and create revenues and create profits. So when you have assets, you can create profits. As you grow your assets, then you're likely to be able to grow your profits as well. You have shrinking assets, it becomes harder and harder to create growing revenues and growing profits. So it really starts in the balance sheet, in my opinion. You can find some really great deals by buying stocks that are trading at a discount to their assets, to their equity. It's also called book value in the investing world. There's a lot of great discounts there, but at the same time, you also want to make sure that the assets that a company has are profitable. You want to make sure that they are efficient and creating profits, because at the end of the day, it's all about profits. Why do we buy businesses? It's because they create profits. Those profits can shoot off dividends to investors. We can take those dividends, reinvest them, and create more wealth for ourselves. And then as the business continues to grow and continues to make more and more earnings, can buy more assets to create more earnings, we have this like compounding force and this compounding ball of wealth that's being created for everybody who's involved. And you're not going to see that if a company is failing on the income side. So we talked about the falling knife and the debt to equity. That's where the balance sheet also comes in. So I really, really stress making sure that there's not too many liabilities, enough assets to cover any liabilities that they might have. And that really tells me the health of a company, and it really helps me become confident because I can see it's numbers on the screen. You can't fudge those numbers. So I can intuitively tell a difference between, well, here's a company with a lot of assets. Even if earnings are decreasing for a little bit, we still have a big base of assets that are going to create earnings in the future, compared to a company that maybe their earnings are really growing at a really fast rate, but if we have so many liabilities that they're picking up, then all it takes is one bad year where they're going to have to sell off a lot of assets or take on even more debt. Or if interest rates go up and this company has a ton of debt, now they're not going to be able to borrow at the same levels that they used to. So now they're not going to be able to earn as much as they used to. What do you think is going to happen to the stock price there? So these are the type of things you want to keep in mind. But really, in my mind, the balance sheet and the income statement are a 1-2 punch. It's a really crucial duo, and you need both both sides. And really, when I look at financial statement, I want to make sure all three financial statements are at least decent to my liking. When I look at a cash flow statement, I just make sure that a company has enough cash at the end of the year. And what that balance does is it helps a company stay afloat in the case that they have a year of bad earnings. Cash at end of year is kind of like looking at your checking account and seeing that you have enough money to cover your bills. It's the same kind of concept. So when a company doesn't have a lot of cash, I call it net cash, and it's debatable. You know, some of these metrics can kind of be veiled in a way, but I make sure that there's enough there because I don't want to see a company borrow a lot just to stay afloat when times come. So to me, that's very important, as well as the balance sheet and the income statement. But definitely, I'm putting a lot of emphasis on the balance sheet because that's going to form the foundation. And once that's solid, all the other things usually fall in place. You just got to make sure that, okay, it seems like for the most part, these things are falling in place.
Now, earlier you mentioned the importance that you place on dividends and creating an income stream with your portfolio. What's your opinion on dividend payments versus share buybacks as a method to return capital to investors?
So I'm kind of against the grain on this one. I have a lot of things I follow kind of straight to the book. This is one of those where I'm kind of on an island as far as my kind of thinking on this. And it is a bit controversial. I understand the whole idea of, from a return perspective, it's essentially the same thing to an investor, whether they're buying back shares or whether they're paying out a dividend. I understand the allure of buying back shares in the sense that it's beneficial tax-wise, usually for the company and for the investor. I get that. But for me, I look at it as who's really holding the power here. If a company is your dividend, I'm receiving that money and I can choose whether I want to put it back in the business or if I want to put it in another opportunity, right? So if a company stock that you own is extremely very, very highly valued and you maybe don't want to add shares to that position, well then I would prefer to at least have the option to put that somewhere else. For me, really the biggest thing though, if I can keep it in the most simplest of terms, is when I buy a dividend, when I'm paid a dividend and I reinvest it, every time I get that dividend and I buy more shares, the amount of shares that I'm holding is growing. In the case of a buyback, you're not getting any more shares. The company is getting less diluted. That is true. And so your ownership percentage is growing, but the actual physical amount of shares that you are getting is not changing at all. And so what we have to understand when we look at stocks in the stock market is that the price of the stock is always going to fluctuate. So even in the most ideal situation where you buy a stock that's a discount to its intrinsic value, you're holding it for a long time period, maybe decades even if you're fortunate and it's a good company. It's not going to be perfectly straight line. It's not going to always go up. There's going to be inevitable ups and downs. So what I see when I see share buybacks is that it's very short term, and I see the number of shares that the company has outstanding as something that could be in flux, right? Like we don't know. Like they could buy back shares this year and then 2 years down the road dilute the shares again, and then now it's like we're back at square one. Whereas when I receive a dividend, I know that that's always 100% money that I am receiving. There are instances where it is good for a company to buy back shares, like when the company is undervalued. It's a great way for them to allocate capital. But there always needs to be dividends paid so that the investor, that's how you're really going to compound your wealth over time is by growing your holdings. And you do that by reinvesting dividends. So I know it's kind of against the grain in a way, but over a long term, and I'd take guaranteed return over something that can fluctuate over time. So that's really why if you were to give me option A or option B, I would take a dividend all day long.
Good to know. Now, speaking of dividends, what are your thoughts on using like a dividend discount model as a valuation technique?
Yeah, I know. So I've learned a little bit about it. My co-host Dave actually uses it very well. I see value in it, but I also have my own intrinsic value calculations, and so it doesn't. For me, it's like I got to pick one or the other, and so I use my own intrinsic value calculations when I'm buying stocks. I do see a lot of value in it though, and I think it's a good tool for somebody who wants to try to evaluate whether a stock is a good purchase or not.
Yeah, we've talked a lot so far on this episode about when to buy a stock. What are the signals that a stock, when its financial health is in order and when it's undervalued and when it's trading at a margin of safety, those are all signs that you should buy a stock. What do you think are the major signs that you should sell a stock that you already own?
Well, for me, I'm a younger guy. Still in my late 20s, so my holding period is hopefully going to be for multiple decades. Really, if you look at some of the best stocks and some of the best returns that have been possible in the stock market for the past 20, 30, 40, 50 years, it's really these stocks that have been able to grow dividends over a long time, and a big portion of investors' returns have been from reinvesting dividends. So in my most ideal situation, I'm never selling, and I'm continuing to collect dividends. When you collect dividends and when they are reinvested, what you're essentially getting is a higher term for it's yield on cost. So you're going to get a higher yield on cost with each year that you reinvest the dividend. I'm hoping to invest for financial freedom. To me, financial freedom means having an income stream without having to see my nest egg shrink. So if I can build up a portfolio of a bunch of companies that have really given me a high yield on cost, I can pull a really big income, and they can continue to compound and see the share price grow over time, and that's just going to be like an unending well of wealth, right? So that's ideal, but we have to understand, obviously, we're talking about the real world here, and a lot of businesses are going to not work out in the way that I would ideally like. So the way I structure my portfolio is I split it up into two segments. I have what I call a dividend fortress segment, which is the stocks I'm hoping to hold for forever. And then I have a regular portfolio section. For the dividend fortresses, I am holding on, no matter what happens to the stock price, unless I see negative earnings, unless I see a substantial increase in the debt to equity, or if they cut the dividend completely. I understand not every company is going to be able to grow their dividend every year, so if they're not growing it, that's fine for me. But the second that they say that they're not healthy enough to pay a dividend whatsoever, I'm out. Like, this is my money, and I can pick at what scale of a gamble I want to take. And to me, it doesn't make sense to invest in businesses, even though they might recover, if they're giving you huge red flags, like not being able to turn a profit, not being able to pay a dividend. These are huge basic things that you can find so many other stocks that are able to do this, even during a recession, even during a bear market. It just makes no sense to have my money freely tossed in the wind to maybe work out or not. So that's really where I'm selling the dividend fortress. I'm also a value investor, so I really like to, like you said, buy the margin of safety, buy with a discount to intrinsic value. When I'm really targeting some of these stocks that are written down, I understand that maybe these stocks aren't so much dividend plays as they are capital gains plays or share appreciation plays. And so with those, I set a 25% trailing stop, and to me it's loose enough to where it still gives a company that's maybe not being perceived well by the market. It gives it some sort of a chance to recover, but it's also not going to completely wipe me out. So in the most ideal scenario, I'm picking up stocks that are trading at a discount to intrinsic value. What's great about dividends and what's kind of the downside to trying to buy dividend fortresses, as I call them, is that I'm not always going to have great dividend opportunity all of the time, especially in this day and age with a lot of focus and the chase for yield with the low interest rates and a lot of dividend stocks being bid up. Even though a stock might pay a great dividend, if you get in at a terrible and very expensive price, it's going to be hard to see that capital grow regardless if they're able to keep the dividend up or not. So I play on the value investing side. I play with these trailing stops, and then when I see a good dividend opportunity, I'm rolling a lot of those positions into a dividend fortress and then just sitting on that, hopefully for several decades. It's the kind of approach I take, and what's nice about attaching trailing stops to the more intrinsic value focused picks is that I never have to guess when I want to sell. It's like, you can have so much of a back and forth, like, man, I should have held on because it just continues to skyrocket, or I should have got out because it was so overvalued. You can play that guessing game all day long for the rest of your investing career, or you can just set an easy rule that says, you know what, I'm going to let the winners run, and then once they run out of gas, they fall 25%, and I'm going to sell out. And then when it comes to the dividend side, I have a significant part of my portfolio that I'm going to ride out no matter what. And it's going to ride out any bull market, any bear market, and I'm just going to continue to collect dividends, continue to increase my yield on cost, continue to increase the amount of income I'm receiving every year. And that's kind of how I approach the buy side and the sell side.
Given your focus on dividends and income, do you own any MLPs or REITs?
So at this time, I don't. I held a REIT for a while, and it did fairly decently for me. That was one of the more regular positions where I had a trailing stop and I sold out at a profit. For me, it's like I like what they're doing, and I like the idea of having, like for a REIT, for example, they're required to pay out a certain percentage of their earnings. I think that can be a fantastic opportunity. And I really think it depends on the timing. It's just the way that I've been investing so far. I haven't particularly seen one that I want to hold forever, so I haven't added it as a dividend fortress in this time. But, I mean, the option's always there, and I don't discriminate in that way. I analyze them like I would a regular stock. And so if they're giving me those financials that say it's a green light, then I'll shoot, no matter if it's a MLP, REIT, or otherwise.
Just thinking about today's stock market now, MLPs and REITs are something that Sure Dividend sees as an opportunity right now. They're kind of hammered in today's, in a rising interest rate environment. They've gone down quite a bit, and yields are higher than they normally have been. And with the crash in oil prices, energy MLPs in particular are attractive. So, as a segue from the discussion of MLPs and REITs, what opportunities are you seeing in today's stock market?
Loaded question. So I've been burned in the past year because I really tried to time a bottom in retail, and that just did not work out for me. I had some stocks I stopped out on where, some of them actually did rebound like I thought they would, but I was too early and they continued to crash, and then I stopped out. Had some others where the stock price has yet to recover. Really, the way, even today with all the different things that's been going on, each one of my picks has been in a different industry. I tend to pick a lot of these unknowns. I call them like the backbone of America. It's a lot of these stocks that you don't hear in the day-to-day. Sometimes they're B2B business models. Sometimes they're just such small stocks. I like to play in the let's say 1.5 to like $10 billion market cap range. So again, I try really hard not to focus on a particular industry, and it tends to be what the numbers are telling me, where I'm finding discounts to intrinsic value. And so while I might see, for example, you mentioned oil, there's a lot of energy companies out there that seem to be a good value right now. I've been burned with those as well. But I'm not discriminating against any industry. I'm gonna find stocks that are undervalued So a big thing too that I look for, I haven't mentioned this yet, is I really want to see long-term growth. Something that I'm picking up on more and more, and kind of, not that I'm not buying undervalued stocks like I was before. These stocks are still undervalued, but I'm putting maybe less of a focus on being super, super discounted and more so having great long-term growth. And so what that's been doing for my picks lately is it's kind of been spreading them out in the sense that I'm not concentrated in one industry or another. The way I kind of look at valuation is, again, like another contrarian approach, where a lot of people like to focus on metrics. And I love metrics. I use stock screeners. I screen out for particular metrics, and I have my rules. I might bend the filters a little bit here and there to evolve and to react to what's going on in the market. But when I look at something that I want to say it's undervalued, I'm looking from a big picture perspective. So to me, like, for example, a stock that has a PB under 2 and it has PB of like a 0.5, I'm not going to go crazy happy about the PB at being a 0.5. I'm just happy that it's below a 3, because also the price to sales and the price to earnings and the price to cash are around where I want to see them. And then that second component, the growth that I'm talking about, that's also extremely important. I want to make sure that in the past decade, it's really been growing back to the balance sheet. You know, is that shareholders' equity really growing? I feel like that's not talked about enough on Wall Street. Everybody talks about earnings growth, but what about shareholders' equity? We're not going to have earnings growth, sustainable earnings growth, unless the assets are growing. And so, you know, a company can cut costs all day long, but at some point they're whittling to the bone. And if you're not growing shareholders' equity, that's essentially what the company is doing to continue growth. And so I'm making sure that my growth numbers are there, and then my valuation metrics are reasonable, but not necessarily like the most discounted. So I think, to answer your question, I think that's really why I haven't been cherry picking a lot of different industries, because I'm not going for what's cheapest now. I'm going for what's reasonable with great growth. And so that's really kept my horizons really broad and has opened up a lot of different opportunities. And I guess we'll see how that plays out.
Your comments are interesting because, you know, in today's stock market, at least until today, there's like a 5% drop in the S&P 500 today. But, you know, until today, many of the companies with spectacular growth records have been trading at valuation multiples that are far above their normal ranges. So, you know, with that in mind, what are your thoughts on the current market valuations? And do you think that valuation contraction could be a big issue for investors from this point forward?
I think it's always a potential problem for investors, and that, I think it's scary, right? I want to be 100% clear when I'm talking about companies with great track records of growth. Valuation is extremely important still. Like, I'll give you an example. The stock I just recommended for my newsletter in February. On Wall Street, like, the growth, as far as from a short term, it wasn't anything spectacular. We're not talking about like an Amazon that's quadrupling revenues or anything like that. But, you know, good earnings growth. And what I see over a very long time period, I like to look at 10 years. So I think that gives me kind of like a over the horizon look compared to what the rest of Wall Street's looking at. And so I'm still able to, like, that stock pick had a price to sales of around 2, price to book around 2, price to earnings maybe around 20-ish. So we're talking about, like, you compare it to the rest of the market, it's still objectively undervalued. That's kind of where I like to play, just to give you a sense of what I'm talking about when I talk about growth and value. You can talk about things like the Schiller PE. I believe last I checked it was around 32. The median PE right now is around the 26, 28, something along that range. So, you know, the thing is, like, everybody wants to predict, and because we have this very short-term memory, we can remember that 2008 was so devastating, and that the bull market leading up to that was not high. If you really look historically and compare the 80s, the 70s, like, and then you compare like the one we had from 2000 to 2007, It's not that long. And you can define bull markets in so many different ways. Basically, the way I see it is, yes, is historically overvalued. Is it overvalued to such a point where I think it's going to implode tomorrow? Maybe. I don't know. Not necessarily. I mean, I think this bull market could reasonably go on for another 10 years. Look at interest rates, right? If you look at interest rates since the 60s or 70s, we've had interest rates below 1% before. So even though the media wants to talk about, I know a lot of finance people who are way smarter than me like to talk about the government debt and the zero interest rates and all those types of things. But we have had interest rates below 1% before, and we have had very high rise in interest rates, and the market has, in the past, it's reacted, and in the future, it will definitely react as well. But that's the thing, we're all speculating, and because we saw what happened in 2008, you could argue, on one side of the coin, you could argue that we're all kind of pricing that in, and so maybe we're not as exuberant as it was in, say, 2007 or 2000. You can argue that because some stocks are still very reasonably priced. You can also argue the other side of the coin and look at things like crypto and talk about how those are just historic bubbles that we've seen crazy amounts of cash go into those. You can go either way, and so I don't like to make a stance to say it's one way or the other, but I think it really is crucial. If you look at stocks that have been very highly valued, you look at the dot-com stocks, you look at real estate when it was at its bubble. History has shown us time and time again that high valuation is never sustainable. I love the example of Microsoft because I think it's one of those companies where you look at it today, right? It's so prominent. It's such a big company. So many people use it. It's been a cash flow machine, all of these sorts of things. It's a fantastic company. But when it was trading in the year 1999, 2000, it had a PE around 50 or 60. It took it 17 years about to actually get back to the same market cap it had back in 99 and 2000. In the same time frame, the S&P doubled or something in that range. So you're talking about huge losses for investors who invested in a fantastic company, but because they didn't care so much about valuation, they didn't get to see the kind of returns that everybody else saw when the market recovered. So that's the type of things. This Microsoft case, that's not an isolated incident. This has been shown time and time again. Look at Cisco. Look at, you can pull up countless examples. And so it's so important that even though the market might be overvalued as a whole, you want to make sure that your own individual stock picks aren't, so that way your drawdown is going to be less. That's essentially what it comes down to. You're going to have less drawdowns when the market inevitably goes from irrationally exuberant to more pessimistic. That's just what history has shown us, and that's just the way that stock market pricing works, and that's the way valuation works.
So when market valuations are above their historical averages like they are today, your recommendation is to just find pockets of value so that if valuations do contract, your portfolio will not be as affected.
Essentially, yeah. And again, I take somewhat of a contrarian approach in the sense that I like to be 100% invested all the time. I think a lot of that has to do, again, with my age. If you're looking at retiring in 10 years, it doesn't make sense to listen to what I'm saying because you're going to have a completely different end goal and you're going to have a completely different time frame for when things can recover. For me, I am dollar cost averaging. I'm always putting consistent amount of money in the market every single month, and I want my stocks to make dividends. I don't want to miss out from any of that. So I'm always 100% invested, and so yes, I'm going to try to find these pockets of value. And to this day, so I have my intrinsic value calculator, if you want to call it that. I call it the value trap indicator. To this day, I'm still finding stocks that are strong buys on the value trap indicator. In the case where that's not feasible anymore, I might change my view. But as of now, I'm having no problems. I'm finding plenty and plenty of pockets of value where I can pull the trigger and pick up a stock here and there. So I'm definitely, even if I'm selling, I'm constantly reinvesting and getting back in the market. So I just understanding that, if you look at the S&P 500 as a whole, for example, it's market weighted. So that means that stocks with higher market caps are going to affect the index more. That also means that the stocks that become bubbles, the ones that become very, very overvalued, those are going to be the ones that push up the S&P to higher and higher levels. So when you look at investors like Warren Buffett, who it seems every time that there's a big bull market, people like to laugh at them because they're like, well, look, you're not in tech stocks. You're losing it, old man. Like you're underperforming the market. These narratives, they never go away, and it's because he's kind of doing the similar thing. I mean, I don't know what his portfolio is exactly, but I know he does have a large portion of it still in the market, and he has done that for decades. And it's worked very well for him because when valuations finally drop to their historical norms, he doesn't see the same type of drawbacks that somebody who maybe was an indexer and had a higher weighting on the overvalued stocks might have had, or somebody who really went crazy about the tech stocks. So yes, I find pockets of value. They might not be as discounted or as much of a barn stock as I like, but they're still reasonably valued. These valuations are still reasonable when you compare it to what the average is out there and historically as well. So as long as everything's kind of behaving in that sense and I'm getting the growth, then that's where I'm going to be pulling the trigger.
What are your thoughts on diversification? More specifically, how many stocks in an ideal world should an individual investor hold?
So I've seen in a couple different books, they talk about anything up to 21, it starts to get saturated and you start to mimic what the market does. So I tend to try to stay 15 to 20. What gets complicated is that when you're dollar cost averaging, you're not going to be perfectly weighted in every position. So for example, I like to make the example that anybody can make a portfolio with just $150 a month. So I really like to talk to the average investor, somebody who's just our everyday worker going to the office or going to work construction, wherever that may be, right? So I have a portfolio that I'm personally funding, and I put $150 a month in it. So if you kind of extrapolate that out through the years, right? Year one, month one, we have $150. In year one, we have $1,500. Year two, we have $3,000. So each month that you're putting in this dollar cost averaging amount, that 150 is becoming a smaller and smaller percentage of the portfolio. So I think when people talk about 15 to 20 stocks, if they're not mentioning dollar cost averaging, when they're talking about diversification, they're kind of missing like half the discussion. So when somebody says 15 to 20 stocks, what that really needs to say is 5 to, let's say, 7.5% position sizing. That's really what we're essentially talking about. That's one thing that technical analysis does get right, is they talk about position sizing very, very intently. So I think the question more becomes, let's make sure we try to get position sizing of around 5 to 7% and try to keep it in that way. The thing is, though, like, because I talked about how I see certain dividend positions or dividend opportunities and I really want to pounce on them. I've historically had stocks where I'm 15 to 20% concentrated in them, making big bets. And it's something that's constantly evolving because my portfolio is constantly growing, right? So it's really not an easy answer that I'm sure you wanted to hear, but I think in general, you want to think anything above 20 stocks. Now you're talking about a 4% position size, 3%, 2%, 1%. You're really going to get close to the market average with that, and you're really going to lose the diversification benefits in the sense that you might as well just buy an index. At the same time, you might not want to be so invested that you could see, let's say, 10% of your portfolio disappear overnight, right? That might be something where a stock goes bankrupt and you don't want to lose 10, 20, 25% of your portfolio. But I think if you're confident and you have certain opportunities that you know are just going to be better than something that you might see in the next year or two, I like to kind of pick my spots and get higher concentrations. But in general, I'm going to be somewhere around that 5 to 7 to maybe 10% concentration range.
Now, just to wrap things up, I was curious if you had one piece of advice for a beginning investor today, what would it be?
That's a good question. And I love it. I just answered one to somebody recently online. So I'll break it down this way. He's like, let's say you're starting out as a beginner and you wish you could tell yourself 3 things. These are the 3 things that I would say. I would say, number one, that I wish I would have done myself. Number one, don't forget growth when you're searching for value. That's so key, and we already touched on that today. Number 2, make sure you get into investing books and you start reading right away. Like if you don't feel like you have a confident grip on investing, then you're really wasting time by not digging into these books, because you're going to reach a point where you start to see the investing books that everybody recommends and they start to really kind of parrot themselves, and that becomes a good thing, because now you're able to see that some of these principles are really timeless and a lot of people have practiced them and seen them to success, and you can see that for yourself. So I think time not spent reading, especially in the beginning, I think it is a big opportunity. Even today, like I'll just read kind of when I'm in like a reading mood, but when I first started, I definitely tried to read as much as possible, and so you kind of just have to get over that hump and really dedicate yourself. But it can be so financially rewarding, and it's something you can take with you for the rest of your life. So I highly recommend it. And then the last thing I would say is something I also said earlier, is don't try to time a bottom. I don't necessarily go chasing momentum, but at the same time, it's really hard for a stock to turn, even if it might be a great value, when Wall Street hates it. So not to say that maybe I wouldn't have bought some of the stocks I did, but I'm more cognizant now about trying to understand that, well, if the stock's a buy, it's a good buy. And so if I wait a couple months for it to kind of bottom out, level out, maybe start a little bit of an uptrend, am I really missing out that much in the big picture? So those are some of, I guess, the 3 big things that I would really try to tell somebody who's just getting started, that those are things that I've seen in my own experience that have proven to stand out above everything else.
Awesome. Well, thanks so much for taking some time to talk with us on the podcast today, and we look forward to having you back.
Yeah, thanks, Nick. It would be great to come back. I did have Ben on my own podcast. It was, I believe, episode 7. So if you guys want to listen, that was a fantastic discussion. We talked dividends, we talked value investing. So that's my podcast, is the Investing for Beginners podcast. Also, investingforbeginners.com. We have show notes there as well. And that's kind of where I'm at if you want to find me.
Thanks so much for listening to today's episode, everyone. I invite you to check out our website at sureinvesting.co, see our premium investment research at suredividend.com, and also check us out on YouTube, where we publish videos under the name Sure Dividend. See you next time.